Would you like to know things like, can I buy a house even if I'm changing jobs? What if I haven't started my new job yet? How about, do you need to sell your current home before you buy the next one? And then, do you even know how to get pre-approved or how a pre-approval is different from a pre-qualification? Well, I'm going to answer those questions and more in this video, so stick around. But first, in order to be compliant, let me introduce myself. My name is Linda Shinpaul. I'm a licensed loan originator with Edge Home Finance, and we are the #1 national mortgage brokerage in the U.S. Let's start with question 1. How do you qualify for a loan? Well, the first thing you do is you need to connect with a lender. And then you're going to provide employment, income, debt, and asset information to that person. We're going to determine how much you're putting down. We're going to ask you a whole bunch of nosy questions, do some math in the background, and then we're going to give you an idea of what we think you would be able to spend on a new home. Now, people ask me, Linda, do I need to drive across town and sit in your office? Like, how much time is this going to take? And the answer is no, you do not. Almost all of my clients make application online, and it's really about a 15-minute process. You're going to create a secure account. You're going to follow the tutorial and enter your name, your address, your employment information, where you have your money for the down payment. You're going to click a few declarations, and then you're going to authorize me to pull your credit and work on your behalf. So it's really that easy. And then how we're going to communicate is we're going to have some phone calls. I like to do Zoom calls so you can see me and we can interact that way. I can also share my screen and go through some of the fee sheets with you and the math. It makes it super easy that way. And of course, email and text. The next question I want to go over is, what's the difference between being pre-qualified and pre-approved? So a pre-approval does take more time, but it carries a lot more weight, okay? I will need more documentation from you, but it shows the realtor and the seller that you are ready to buy. Pre-qualified is when I just do a quick overview of your finances. I did that earlier today. I was talking with a nurse. She had about 10 or 15 minutes on her break. And I said, I'm going to call her Becky. I said, Becky, okay, let me ask you some questions. How long have you worked at the hospital? How do you get paid? Is it a salary? Is it hourly? If it was hourly, how many hours a week do you work? Do you make overtime? Okay, great. How much money do you have to put towards the transaction? All right, $5,000. Perfect. Do you have any credit concerns? No, Linda, I've been current on everything, but I do have some student loans. I said, okay, great. Do you have a car payment? What other monthly bills do you have? So it's this kind of an exchange, and we did that over the phone. And while we're talking, I'm typing and doing some math, kind of like at lunch when you write something down on the napkin to try to figure it out. That's really what it looks like. But that's a pre-qualification. And listen, after 23 years in this industry, I pretty much can feel really good about that pre-qualification when I'm done. But at the end of the day, my answer as far as how much can you afford, or do I think you can go ahead and make an offer on a house in that scenario, is only as good as the information you give me. And you're not the loan officer. You don't always know exactly which numbers I need off your tax returns or your pay stubs. So we have to be really careful when we're doing a pre-qualification because it's a guide. But with the pre-approval, I am going to verify your financials. Okay, I am going to look at your bank statements. I'm going to look at your pay stubs, your W-2s, your tax returns. Any number that I put on the loan application, I'm going to verify it with a physical piece of paper so that I can make sure that I have put the correct information in. And that's how I'm able to get an answer equal to what underwriting will give us. So that's the pre-approval, and that's what I like to do. So then you can go look at a house and be 99.9% sure that you're going to be just fine. All right, so how much should you save for a down payment? Well, this question has a myriad of answers. You can save from 0 to however much money you want. And let me explain that just a little bit. If you have access to VA eligibility, then you can come to closing with 0% down. Same thing in a USDA loan if you qualify for that properly. So those are two very mainstream loans that allow you to bring no money to closing. With FHA, your minimum required down payment is 3.5%. However, it can be gift money. So arguably, you can get that down to almost 0. With a conventional loan, you're going to have 3 or 5% minimum down payment. We'll explain that on a one-on-one basis. Plan for 5%, okay? But if you put 20% down on a conventional loan, then you don't have mortgage insurance. And you may or may not know, but mortgage insurance is something that the lenders charge when you put less than 20% down because it protects them in case you were to default. And they're not picking on you. They've just run the numbers for so many years. And statistically, when you put less than 20% down, the chances of default just go up. Okay. Regardless of what you bring for a down payment, please make sure you have some reserves. The last thing you want to do is put every dollar you have into your new house only to need a new air conditioner or have a medical emergency or, whatever may come up 30, 60, 90 days down the road. So always factor in setting some money aside. So now that we know that there are a lot of different options as far as down payments go, let's talk about how much can you afford. There are a lot of public figures out there in the financial space that suggest 25% of your income is a good number to put towards your monthly mortgage payment. And that's a great conservative number. We can typically get you approved up to 45%, and with a VA loan, sometimes even 60% or higher. Not saying that's a good idea, just telling you what I see get approved all the time. So the bottom line, though, is it doesn't really matter how much money I can get you pre-approved for. What matters is what is a comfortable monthly payment for you. What do you want to write a check for each month? What do you want automatically coming out of your bank account? I would compare that to what you're paying in rent right now or what you're used to paying in your current mortgage, and maybe you just got a job promotion and you can factor in putting some of that towards it. But at the end of the day, that's your call. Just figure out a reasonable budget and stay within it, and you'll be happy in the long run. So let's say you're not a first-time home buyer and you currently own a home. You're upsizing, you're downsizing, you're moving across town for a new job. Maybe you want the kids to be closer to a school, whatever it is. And you're trying to figure out if you should sell your current home before making the move and the next purchase. Well, 12% of people don't. And a lot of those folks are going to use that current home as their first investment property or as the next investment property in their portfolio. And this is really a wonderful option. My husband and I did this a long time ago when we each bought our first house. We used an FHA mortgage with 3.5% down. And I know for a fact, both of us had seller contributions towards our closing cost. We were in our mid-20s, we were getting started, and we were kind of scraping together everything we could to buy a house. But a couple years later, when we got married and then bought a home together, we realized that those little houses we started in would make great rental properties. So we kept them. And that was the start of our real estate portfolio. So if that's something you're interested in, I can totally help you and talk to you even like on a personal basis and share those experiences. But I can certainly crunch the numbers for you and see if you can pull it off. You might just be able to buy that next home, put together the minimum down payment, and start your real estate portfolio with the house you're moving out of. So what if you're switching jobs? And maybe you just graduated from college and you haven't yet started your new job. Can you go ahead, get pre-approved, and buy a home? And the answer is a resounding yes. Now, that might surprise you, but it's all about the documentation. So if you're switching jobs, we need to document that. We need to know when the current job ends and when the next one begins. The most important thing is going to be the job offer letter and the start date of the new job. And so we don't want to have too big of a gap in the middle. And it would help a lot if it made sense, if the job switch made sense, right? If we were in the same line of work, so on and so forth. But maybe you just graduated from college and you have your offer letter and you're not starting for 3-4 weeks, maybe even 2 months. Is that going to be a problem? No, it's really not. Once we figure out which loan program we're going to use for you, then I can give you the exact guidance per the guidelines. I do this at least a half a dozen times a year where I have people. I just had a couple last year. They moved from Utah to North Carolina. He graduated from Brigham Young University and he's a project manager. He was working for a builder. And I talked to him while he was taking his finals and he already had his job offer letter. And I was able to get everything pre approved. They made the move cross country and they actually just had their first child and they are loving their new life. So it works out. I know we're getting pretty technical here. A lot of people making these videos just skim over the top with high-level questions and answers. But this is important for you to know because these are the things I get asked a lot. These are the real specific questions that I hear. So if you need more help than what I'm giving in this video, please book some time on my calendar. I'll answer your questions personally. And there's a link in the description and you can grab time that way. All right, so let's move on. How do you know which mortgage is right for you? Well, that's really not your job up front. So don't panic if you don't have a clue. It's okay. And if you've done some research, that's great too. It just allows us to kind of start a little further down the lane having our conversations. But at the end of the day, there are a handful of major loan products. FHA stands for Fair Housing Administration, and it's designed to help more people buy homes. There's a little more leniency for credit, debt to income ratio, things like that. But there is a maximum loan limit. And in a normal real estate market, for 2025, your maximum loan amount is going to be $524,225. Now, if you go to Alaska and the Virgin Islands, we can go over $1.2 million. There is a range. FHA allows for a higher loan amount in high cost areas. VA and conventional do the same thing. They follow the same maximum loan limit. Basically, VA piggybacks on the conventional loan limits. And in 2025, the conventional loan limit is going to be $806,500. That's in a normal market, and it's going to go up to the same amount as FHA, the 1.2 million. So, depending on what market you're in. So that just tells you that if you're in a normal real estate market and you want to buy a $650,000 house, more than likely we're going to be going in the conventional, we're going to be playing in the conventional mortgage world. Okay. If we exceed the conventional loan limit, now we're in what's called a jumbo loan. And typically with a jumbo loan, you need a little more money down, a little bit better credit, but it's the same thing. 30-year fixed, 15-year fixed, adjustable rate mortgages. If you don't know what those are, I'm going to talk about it in a minute. But that's what a jumbo loan means. It's just bigger than the conventional limit allows. Final group of mortgages is a non-QM group. These are untraditional mortgages. So for example, let's say you're self-employed and you've got a really good accountant and the money that you make and the money that you pay taxes on varies greatly. And you know what I'm talking about if you are in this situation. Well, how about if I could use your bank statements and we could look at all those deposits that come into your business and use that as income? That might change things for you, right? And so that's what non-QM products are for. They're for folks that just need an alternative form of documentation. We have bank statement programs. We have DSCR, which is where the rental income on a property actually qualifies the property. You don't. We also have things for folks who aren't U.S. citizens. Maybe you have an I-10 instead of a social security number. There's a whole nother group of mortgage types there. But you don't necessarily need to come to the table knowing that, but some of these options should be presented to you during your loan consultation. All right, so I hinted at this. What is the difference between a fixed rate mortgage and an adjustable rate mortgage? An adjustable rate mortgage is also called an ARM, A-R-M. Well, the interest rate on a fixed rate mortgage is just that. It's fixed. It never changes. An ARM, an adjustable rate mortgage, can change multiple times over the life of the loan. So what's better? Well, it just depends what your goals are. If you want the safety and security of this is my interest rate, my principal and interest portion of my payment will never change over time, and maybe interest rates are really low and you're very happy with that number, great. A 30-year fixed or a 15-year fixed, but some sort of fixed rate mortgage is perfect for you. If you're just passing through, maybe you move every 3 to 5 years with your job, might be some sort of district manager or area manager, and you are working your way through the entire organization with your company. If you can get a lower rate on an adjustable rate mortgage, then that might be a good option too. ARMs have lots of different terms. I have seen them be adjustable from the very beginning. I have seen them start adjusting after 6 months, 1 year, 3 years, 5 years, 7 years. So there are a lot of different options. And basically, if you think that you're interested in adjustable rate mortgage, just make sure your loan officer really explains it to you, because you're going to have an interest rate for a certain period of time. Then after that, and you'll know it's in the terms of the loan, then after that first upfront fixed period, your interest rate's going to change. When it changes, you're protected. It can go up or down only so many percentage points. Again, that's in the fine print. And then it will adjust every so much time after that. So you're going to have an initial adjustment period. You're going to be protected for it to go up and down only so much, and then it will regularly adjust in the future after that. So we're going to let it be at that. They are great products if you have an appetite for that. So should you be shopping around for the best loan and rate with online lenders? I am going to tell you, no, you do not want to do that. Now, listen, it's a great idea to shop your mortgage, okay? This is most of the time the single largest transaction of your life. So I'm not telling you to take this lightly, but here's the deal. If you go online and fill out 3, 4, 5 loan applications with all of these big banks, you are going to get bombarded with emails, texts, maybe phone calls, not so many phone calls as you think, but you're just going to get bombarded with solicitations. And you're going to get some sort of pre-qualification, some sort of a approval, I'll call it, that probably doesn't mean more than the paper you would print it on. And here's why. A lot of times you're entering that information online and nobody's calling you to verify it. They have AI in the background in a computer system going, yep, that looks right. They filled out all the boxes. There's no holes in the application. So we're going to spit out the approval based upon what they gave us. And if you go back to the very beginning in this video, remember, to get a real approval, you need a loan officer reviewing your loan application, comparing the information that you entered with the documentation that supports it. That is the only way you can trust that approval. And so a lot of these big banks don't do that. Then what happens is when you go under contract, you think you have an approval for $550,000. You think you have an interest rate of normally lower than the market is really bearing, and it all gets changed on you. And you get a week or two into the process and it doesn't go well. And I've seen people lose their escrow money, and I've seen some people not even be able to buy a house because the approval was so poorly done from the very beginning. Not your fault. You don't know. But unfortunately, that's how a lot of the online banks work. Now, as far as shopping around, if you go to a bank, you probably need to go to another bank and another bank to see how they compare. I'm a mortgage broker. I have over 100 different banks that I can work with. So you don't have to do all that shopping. I can do it effortlessly from behind my computer for you. And that's what I would recommend. I would recommend that you do use a mortgage broker, somebody that you trust, who's explaining the process to you. And if you feel like you understand what's going on, then they're going to go shop their lenders for the very best rate and terms based upon the product that makes the most sense for you. So that's my recommendation. How do you lock an interest rate? Well, the first thing you need to do is you need to go under contract on a home. So you need to make an offer, and the sellers need to accept your offer, and we need to have an executed real estate contract with a property address, a sales price, and a closing date. Now I can lock an interest rate. Interest rates are attached to the property that you're buying. So if something were to happen during the transaction where you backed out of the deal for whatever reason, then that rate lock expires with the cancellation of your real estate contract. And then when you go back out and find another home and go under contract for it, we'll lock it and start the process all over again. That's how it works with locking interest rates. How about mortgage points? This one I definitely want to make sure we talk about. Points aren't required, okay? These are also known as discount points, origination points, buy down points. But at the end of the day, a point is 1% of the loan amount. And basically, you're prepaying interest or profit to the lender in exchange for a lower interest rate. They're legit, but they get way overused and abused, in my opinion. So let's say a normal interest rate today is 6.5%, and that would be with 0 points. And you say, Linda, I like that, but can we get the rate a little bit lower? Sure, let me give you a couple options. So I might say, we can go from 6.5 to 6.25, but it's going to cost you a half a point. Okay, can we get in the fives? Well, we might be able to get in a high 5 interest rate, but maybe you have to pay a point and a half. So just know that when you pay points, typically you are buying the interest rate down, and the lender can't give that away for free. They're just going to take the profit that they would have made with the higher interest rate and collect it up front in the terms of points. You will pay points as part of your closing cost, which is a natural transition into our next question of, well, what does the seller pay and what do you pay for at closing? This can vary greatly depending on your loan product and where you are geographically in the country. So loan products. With a VA mortgage, there are certain things that the borrowers cannot pay for. They're called VA unallowables, and they will not allow the borrower to pay for certain fees. They just have to fall on the seller side. I could go to FHA. If a second appraisal is required, the buyer can't pay for it. So now we've got to ask the seller to do that, and so on and so forth. There are lots of little examples, but typically per state and even per county, sometimes per city, there are usual and customary ways of divvying these up. And so before you even go under contract, when I do your pre-approval, I'm going to give you a fee sheet and I'm going to show you this. So this shouldn't be a surprise moment at closing. You should know from the very beginning what to expect within a reasonable amount. You should also know what your mortgage payment's going to include. A typical mortgage payment includes principal and interest, homeowner's insurance, property taxes, and PMI if you don't put 20% down. That's really it. And your mortgage broker should separate those out piece by piece and explain those to you. And I would be remiss to not take the mortgage payment conversation and talk to you about your escrow account, because a part of that monthly payment that you make to the mortgage company actually gets set aside into this account. So an escrow account is an account the lender uses to basically hold the homeowner's insurance and property tax fees that it collects every month from you, and they hold those until the annual bill is due. This is great because a lot of people just aren't able to keep up with setting that money aside and then a year from now having thousands of dollars of expenses having to go out at once. So every month, your mortgage payment is going to have principal and interest, but then they're also going to collect 1/12 of the annual property tax and homeowner's insurance bill. That 1/12 every month just goes over here to the escrow account. Think of it like a savings account. And then when the property taxes come due, sometimes they're due once a year, sometimes they're due twice a year. Again, that depends on where you live in the world. But when they come due, that bill goes to your mortgage company and they send the payment in for you. Likewise, 1 year from closing, your homeowner's insurance comes due. Some of you've got some pretty cheap homeowner's insurance. Others, you might live in Florida on the water, and that's several $1,000s a year, if not $5,000, $6,000, $7,000 a year. So it is nice when the mortgage company is collecting that for you and then just shoots that money off as it comes due. And the mortgage company has to pay the property taxes and the homeowner's insurance bills as soon as they become due. And if you can pay early in order to get a discount, they also have to do that for you too. All right, I'm going to throw in a bonus question before we finish up here. I get asked this question all the time, and it might even be the first question most people ask me, Linda, what are the interest rates right now? What would my interest rate be? This is not a one-size-fits-all answer, not even close. And any lender that quotes you a rate right away is totally guessing and making it up. I know that's a pretty bold statement, but it's true because interest rates are so dependent on your individual credit profile. We need to know what your credit score is. We need to know how much money you're putting down. We need to know the type of home that you're buying. There are so many variables that make up an interest rate. If this isn't the good old days where you'd walk into the bank and they just have a little piece of paper sitting on the desk and they go, oh, today's 30-year fixed rate is X. take it or leave it. It's not how it works anymore. There is a grid. It's very complicated going on in the background of all these mortgage quotes. And it's just not a one size fits all answer. And even if you tell me you have great credit and everything's on time, I need to see your credit report. I need to see that score. It's not that I don't trust you. There are just so many things that happen in a credit report. There are a lot of mistakes on them too. So if you call me and ask me what are rates right now, I might give you a range just to satisfy you so you can know what's going on in the market. But there's no way that you call me and I tell you this is your rate to the T without pulling your credit, doing a full pre-approval, and being able to really, really understand what's going on in your world. So I hope you found value in this video. If you have more questions, put them in the comments or set some time up on my calendar and I will answer them personally. It's really important to me that you get the information that you need. Mortgages can be complicated, but it's my goal to explain them simply and to empower you to be able to make a great decision. I'll see you on the next video.